Welcome to the Market Pulse podcast. I'm your host, Maria Urtubey, a member of the Equifax Advisors team. As a group, we identify economic considerations and leverage data and analytics to translate into industry insights and recommendations, ultimately to support our clients during economic uncertainty while uncovering growth opportunities in consumer and commercial credit risk. I'm very pleased to welcome back our panel of experts in the advisors team. Tom O'Neill, Dave Sojka, Jesse Hardin, and our team leader, Emmaline Aliff. Welcome back.
Hey,
Hello,
Maria.
Maria.
Hey Maria, how you doing?
There's still almost a month left of summer, and we're just getting there here in Northern California. In fact, my kids are not starting school until the end of September, and my husband and I are about to become empty nesters. Not sure I'm ready for that. How are things for you?
Well, the calendar may say that there's a month left of summer, but school started, so it's fall, as far as this household's concerned. So,
Yeah, it's a little surprising how soon school starts, isn't it?
yeah.
Yeah, in
In some
Georgia, it's the
areas.
first week of August.
Yeah,
Oh, wow.
So we've been
that's
at it for a
crazy.
while. Yeah.
Yeah, said Caitlin started on Monday, and obviously then we've got the holidays. So she'll always kind of weird coming back. I was talking to somebody at my gym, and it's like, oh, their kids started school today, and then they got the holiday weekend. So, obviously it's
Short
kind of
week.
strange.
Yeah. Well, before we begin, our friends at Moody's Analytics will share a quick economic update.
The US economy is walking a fine line right now. Our baseline forecast still doesn't call for a recession, but the risks are high, and this is reflected by our machine learning recession model, which puts the odds of a downturn in the next year at just about 49%, which is right on the edge of where past signals have always preceded a recession. The pressures are pretty clear. Higher tariffs and tight immigration policies are lifting inflation and holding growth back. We're looking at real GDP growth for around 1.1% this year, which is well below potential. And at the same time, inflation is sticking closer to 3.5%. So we're in a period of mild stagflation, slower growth paired with stubbornly higher prices. And you can really see it in the job market. Hiring is slowed to a crawl, and restrictive immigration has throttled labor force growth. A year ago, the economy could handle adding 150,000 to 175,000 jobs a month without pushing up unemployment. Now that break-even point has fallen closer to 50,000. Without more workers, we just can't sustain the job gains we've gotten used to. Now the Federal Reserve is expected to start cutting rates again in September, but it'll move cautiously, likely trimming a quarter point each quarter until rates settle near 3% late next year. The Fed's trying to strike a balance between supporting the labor market and keeping inflation under control, all while navigating political pressure to ease policy faster. So the risks lean to the downside. A sudden jump in long-term interest rates, a correction in the stock market, or concerns about US fiscal sustainability could easily tip the balance. Now, that said, there are paths to a better outcome. Rolling back tariffs, easing immigration limits, or providing targeted fiscal support could stabilize growth. And over time, AI-driven productivity gains could give the economy a real boost. That's more of a long game. For now, the economy's holding together, but just barely. There's not much room for policy misstep.
Thank you, Moody's. Let's get to it. Over the last months in our podcast, we have discussed key economic themes and predictions at the beginning of the year, all the way to the health of the consumer mid-year. Today, we're turning the focus to our customers. What do the macroeconomic and credit trends insights mean to them? How are they leveraging this information? What are the Equifax advisors hearing directly from lenders? And what have we recommended as next steps? As the Equifax advisors leader, how does the team help our customers and stays tuned into what is relevant for them?
So since about 2020, we've been operating and doing this Market Pulse series, and that started off with our Market Pulse webinar, as many of you know out there. That led into the things like this podcast. Also, what we do is we will engage directly with our clients to conduct with them dialogue that really is I guess, an interaction model that we call our Market Pulse Advisory. And it's more of a one-on-one type of interaction that we will have that brings the level of economic insight that we're observing in the market from policy all the way through to things that are occurring in the credit data. And we do try to understand and help them to figure out specifically if you're operating a credit card, mortgage, auto, how are you impacted differently by the economic policies, and what then is occurring within the credit spectrum space that you're operating in, and are there different actions that you could or should be taking as a part of that exercise. And we'll span a lot of the areas all the way from marketing and prospecting through to more collections based situation to really help navigate really what's going on in the market.
Yeah. Well, you touched on economic and credit trends. Maybe let's dive into that. Jesse, what are our customers focusing on and watching more closely in these areas?
Yeah, so Maria, I think what I would do is, I guess since you went with me first, I'm going to pick the longest running topic I think that a lot of our customers have really asked us about, and that's going to be the student loan resumption. And we talked with customers, from I think 2023 on about student loans and the notion that student loan is the resumption of payments is starting, and then the reporting of those payments and the statuses of those payments were going to start. And it's taken a long time, I think, to kind of get to the point where we're at now, where we started talking at the first of the year about when those payments would really show up and the status of the delinquency status. And so I think a lot of customers were really interested in understanding, who are the customers? What do they look like? How are they structured in my portfolio? Do I have a lot of maybe what we call exposure to that segment of the population, and really just understanding. I think our customers really wanted to understand, what does it mean for them? What's it going to mean in my portfolio? So I think that in my mind, as I think of the Market Pulse advisories that I've done, that was one of maybe the biggest questions we got, is really trying to understand a little bit more about that direction of where student loans is going.
Yeah, and as you said, it took a while. I joined in 22, and that's when we started looking into it. So it's taken a while.
Actually,
I feel like
it goes back even before. Yeah, it essentially we started talking about it when the CARES Act came in 2020. Now, granted, for several years, it was almost like the boy who cried wolf. It was like, hey, we should be looking at this, but there was really no reason to look at it, because the deferments just kept getting extended. People didn't have to make payments. Interest wasn't aggregating. And so the can was kicked down the road for a long time. Finally, as Jesse was saying, in 23, the can stopped being kicked, sort of. The deferment, but they still didn't really have to make payments on it until 24. And then even then, it's like, okay, we're finally at the point where people need to start making payments, or it'll start showing up on their credit report. But even then, there was, okay, well, not until they reach 90 days. And so now we're getting to 2025, and we're finally, after 5 years, at the point where a lot of this is coming home to roost.
Yeah, and then reporting, right, with the on-ramp got postponed as well. So there were all these changing circumstances. Yeah.
Yeah, and I think maybe one of the bigger concerns was like Tom said, and in terms of when do you start measuring, and what are we seeing, but really in the context of the economy. So Maria, to your question, when we've talked about the K shape of the economy, it is like the aggregate of everything that's happening with these consumers, and this was just like one more thing added on top of all the other things happening. So, I think that was maybe an area where our customers were really looking to say, okay, if I know that there are stressors out there, then what does this do as yet another one, added on top of all the other things happening.
Yeah, and you mentioned all of those other things happening. I think, an obvious one that we've been sort of wrestling with over the the past several months now is the notion of tariffs. But similar to student loans, on the surface, it seems pretty straightforward. Hey, there's this topic. We should, measure it. We should see what the impact is and all. But the real world makes that, much more difficult. In the case of student loans, it was deferments and, timelines and what's going to happen and when and, who's going to be impacted. And to a degree, it's very similar with tariffs. Like on the surface, it's pretty straightforward. Here's the topic. We should measure it. But in reality, we know that tariffs is a constantly shifting field. When is it going, when are things going to be impacted? How much? Who's going to be impacted? Not only are they not clear at the very beginning, but it's a constantly shifting playing field. So it's keeping us on our toes for sure.
Yeah, that's what I was going to touch on when I kicked off the Market Pulse advisories back at the FinTech meetup. We had just had the tariff announcement. The big board came out, and there were all the tariffs, and the market reacted by dropping 900 points. And the main thing that I got in talking with the clients I met with was the uncertainty that presented. So, again, in and of itself, tariffs, what does that mean? But it's the uncertainty in terms of what industries is that going to impact? How much does that impact? Does that change behaviors for both small businesses as well as consumers? And then kind of touching on the student loan topic again, well, why did that matter to me? Well, it was the drop in score that many customers were unaware of when, they make loan decisions and they get a score, and that score sits potentially for a year or two. Knowing that this cohort of American consumers were going to be negatively impacted, some as high as over 100-point drop in their score, if lenders were not updating that, they were then going to be potentially making bad decisions or relying on information that was outdated to assess the health of their portfolio. So I think those things is what I kind of heard relative to that economic and credit trends question, Maria.
Yeah, and Dave, you bring up a good point, because there was also the assumption it doesn't affect me. And we've seen in discussions with our customers that 10 to 15% of their customer base holds a student loan. So to some degree, not, of course, everyone is losing 100 points. Some are keeping up with payments, but the volume affected is considerable. And Dave, you touched on you started looking into the differences by industry verticals. Maybe let me shift to Tom on that topic. Can you maybe highlight a few of these differences based on some of these conversations with your customers on what is relevant, and
Sure.
we can contrast the economic and credit trends metrics and how these vary by industry?
Yeah, sure. I'll take one specific vertical as an example. One that I've been working closely with is the credit union space, and as many of you know, the auto lending uh, topic is of utmost importance to most credit unions. It's a primary way that a lot of them bring in new members. It's a big book of business for many of them, especially within the indirect space. And so right off the bat, at the beginning of the year, there was the concern, well, how is the impact of tariffs and everything else going on in the auto industry going to impact our ability to lend, and the volumes and the quality of that lending, business. And it's been interesting as we've been going along, the nature of these advisory session discussions has kind of shifted. Yeah, yes, there's still the desire to know, okay, what is going to be happening within the industry in terms of overall prices of new and used cars and our ability to lend and so forth. But there's been more of a heightened shift in terms of the dynamics of that lending. What I mean by that is, who are the players within that field? How is it shifting between the banks, credit unions, captive lenders, and other types of lenders? Because there has been a lot of dynamic within there, and a lot of it is driven by these sort of market forces that are impacted by tariffs and everything else, supply chain and other topics. So it's another example of where we have this sort of macro topic that we say, well, this is going to be an impact, let's measure it. But how we measure it and how it impacts is different by who we're talking with, at any given point in time.
Yeah, Tom, you bring up a good point. I think when you talk about measuring, and even to some extent, I think one of my learnings really was some of the market pulse advisories that I did is the customer wants to know about and by industry wants to know about the topic of at hand. So how does the tariff apply to my customer base? But it's also understanding like how do I measure that impact, and then what do I do about it? So what is that, what is that next step that I can take that I really am looking for guidance, I'm looking for advisory, I'm looking, for that, that suggestion as to how do I take this information and then apply it to my business? And we saw a lot of that, I think, with customers, kind of back to that student loan discussion. A lot of customers said, okay, that's great. This is happening. I don't even really know, like in my portfolio, how many loan holders I have that have exposure to student loans. Is that something that you can start to help me with?
Right.
And then, okay, now that I know that, what do I do about it? What's the timing? What are the things that I can incorporate into my policies? And I feel like, that was an area that was an aha moment for me, at least, especially by industry. When we think of just like you said, even by industry, but then by sophistication, I think some customers largely were following and understood and were on top of it, and then others were, looking for help. So I think that was something that kind of stood out to me as well when I thought about, by industry, what application was there for, for the advisory work that we've done.
Right. Yeah, and I'd say, going back to what Emmeline was mentioning about the advisory sessions at the very onset of this, and how it's an opportunity for us to share information, but it's also, as we've been talking here, a wonderful way of hearing, directly from the client, and it actually sort of fills a middle ground, between different conversations that we have with our clients. We have a lot of things. Our Market Pulse webinar, for instance, where it's kind of a one-way direction. We're sharing information with our clients and with others. We also have roundtables and panel discussions where the focus is really to listen and hear from our clients. These advisory sessions are kind of the best of both worlds, where we're sharing information about what we're seeing from at the macro level and industry level, and they're sharing information about what they're seeing within their portfolios and at a local level. And it makes both sides of the conversation richer. And to your point there, Jesse, it also starts really fleshing out the value of taking this information at all of the different levels that we can provide, in terms of, not just those macro level, pieces of information, but also, being able to team that with portfolio level analysis, lost sales analysis, things like that, which is sort of bringing the top down together with the bottom up, and doing that in tandem with the clients, which is really what I've found, most enriching, through all of these sessions that we've been going through.
It's in a way cross-checking the relevance of what we are discussing and find, as the hot topics versus what, as you said, Tom, the actual in the field specific topics of interest, and even topics that might create some shift. And I was going to turn to Dave on this specific topic to get us started. How, given these conversations, this listening, how have our customers' focuses shifted for the remainder of 2025 with all this insight and new understanding and these conversations that we're holding?
Yeah, in preparation for this recording, I went back and looked at what were the market conditions back in March. And then I looked at kind of where they were at, back in May and kind of where we're at today. And I would say that the biggest thing early on was the stress and uncertainty of what the market conditions were actually going to be, because we didn't know. There were proclamations made, there were executive orders signed, there were things talked about in 1 week, and then the market reacted. That's either the stock market or the bond market, and then things changed again. So I think there was a high level of uncertainty. When I engaged with clients early on, it was obviously you're in the early part of your 2025 plan. How are you doing the forecast? And many said, because of the uncertainty, we're going to stand pat. And the more recent ones, in some cases, whether that was we're seeing less people applying for credit, whether that be we're seeing less people utilize the credit they have with us, or we're seeing higher or lower repayment of said debt with us, we're having to make changes to our strategies. So I think not enough information early on. We're taking a wait and see approach. What I've heard more recently is, okay, now we've got 6 months, 7 months worth of data. We're going to act on that for the rest of the year.
Yeah, I think that, to add to that, we constantly will be asking our audience what are the various actions they're looking to take. And I think the theme is very consistent, depending on whether or not we ask the audience members, whether or not we're operating it even within our own businesses, and also what we're hearing, even commentary from the Fed. And there's oftentimes a wait and see. We need more data. And I think, leveraging that approach of the wait and see, we need more data, that'll impact things like, will the interest rates change? We're seeing, things, according to, inflation, sitting where it's currently sitting. We're, seeing things like homeowners insurance potentially, continuing to be on the rise. And that all of those things then tie into various levels of affordability. But the biggest point about that is trying to do the wait and see approach. And I think the wait and see really is not don't seek information, it's seek the current information and benchmark it over time. So that way you understand what is the economic perspective, how does that carry through to the credit perspective. And if you're operating in the subprime or prime sectors, what does that mean for your customer base or through the door populations? Will you be experiencing more or less delinquency over time? And really try to understand from a scenario-based planning perspective, should you make change or not? Because oftentimes there could be opportunity that still exists within that uncertainty, and then versus just doing some form of credit restriction, or raising rates or raising your cutoffs and things like that.
One thing thanks. So touch real quick, Jesse, with what Emily you just said in terms of the data and taking an approach. One of the things, going back to the previous topic about differences in industry or vertical, fintechs are very nimble. They can react quickly. They're set up for that. Banks, credit unions have committees upon committees to decide upon, can we make those changes? So I think taking the information that we just said in terms of what shifted and having that information, acknowledging that you might need to act differently will help, again, customers as those things have shifted over the rest of this year. Sorry, Jesse.
No, I think that's a great point, Dave. And I had actually seen some research on that, and one of the recommendations that we've been talking about as part of some of that research is this notion or idea of like a go team, and it's exactly what you said. It's like, what if we build a a team that's nimble and that has the backing of senior management to look at the shifts or pattern changes in the marketplace to say, okay, if we see this action, our reaction is going to be this, and so it's almost like a team that's ready with policy changes a hand, even back to what Em said, not just corrective actions for risk purposes, but also looking at opportunity. And I think it's overshadowed. I think one thing I've seen with some customers now is maybe a focus shift is exactly what Em said, is now that you have a little bit more certainty, where are those pockets of opportunity specific to maybe seeing how some credit segments are reacting. And then that dictates, okay, I'm either going to maybe pull back there and move to a different credit tier, and or maybe just market a little differently. So really taking that data, taking that knowledge, and really starting to shift the policy or the way that you react to the data that you're looking at.
And to ensure, maybe going back to what Dave was saying in the fintech space, how nimble they can react in this go-to team. Jesse, envisioning, of course, the approvals and some of those aspects that might make that reaction when appropriate quick, right? And to keep up with that competition that has that fast response, right? When the growth opportunities merit.
Yeah, exactly. How's it set up? Like, how do we set up that team so that we can react quickly? I think that's the secret when you look for an opportunity like that.
And I would say that what we've also seen in the absence of that, outside of the fintech space, outside of organizations that have a go-to team equivalent, is that the shift is the shift to doing less. Like that wait and see mindset that Emmaline mentioned, that in itself is a shift. It is moving to a more conservative, deliberate approach, outside of these environments that Dave and Jesse were describing, and I've seen that going back to the credit union auto space that I was just talking about. We've seen how, in the absence of this nimbleness, the natural tendency is to go more conservative. We've seen auto lending shifting even more towards the prime, super prime space. Jesse again, mentioned
Same with
the K shape, earlier in the discussion.
Sure.
It's another example of that where, it's not that they're stopping business altogether. They have to make lending decisions. It's what they do. But they're going to do so in a very conservative and, button down approach, given the lack of information that they have.
Yeah, Tom,
I think
I think everybody likes this.
We're all
topic.
so excited.
I just want to respond on that specifically and what you were saying, Em, about wait and see. One of the surprises to me as well is what happened sort of mid-year when we started seeing the consumer sentiment, what we call that soft data, maybe dispersing a little bit from the hard data, that hard economic data, which was at one point showing that things were better and that consumer sentiment was worse, and then sort of flipped around where consumer sentiment's better, and then the lagging data, that lagging hard data, comes in looking a little worse. And so it's like, when you think of wait and see, it's like I'm waiting to see, but what am I seeing? Am I seeing data that's telling me something directly, or am I just like how do I actually think about this data? And that's exacerbated by just the sheer amount of news stories that come out. So it's like how do you actually cut through all the data to better understand? Okay, what am I reacting to?
Yeah, that was the point I was going to touch on. I've had the opportunity to speak with many auto customers this year, and specifically knowing how front loaded that space went, because we of course are operating with dealing with the overall macro conditions, dealing with potential credit losses, but then there's also the how are people in general reacting to these things, either from a sentiment standpoint or their own personal interpretation, whether that's informed or not, on the economic policy. And so we did see a lot of front loading, in particular in the auto space, with many of our customers having really strong first half of the year, and now we're trying to see where that will end up going into the second half. But again, there's certain things we may or may not be able to predict that, and so it's having the opportunity to know if people do have an interest, what is that interest, where is it coming from, and do they have the capacity to operate their credit within that within the loan that they're looking to offer, the deal that's being made to them.
Let's switch a little back in the interest of time, and of course we would need a longer podcast to address all of these insights. And I appreciate again the candid share of all the differences, right, that we get to expose and contrast here. To wrap up the discussion, and specifically with all these different nuances that we are addressing, what if we were to bring up, if I were to ask you for one recommendation that has resonated the most this year, if you could share which one would that be, and then which one has not stuck as we had envisioned originally? If you could share that top recommendation and which one has not. Should we start
with Dave? You want us to all go at once?
Okay, Jesse, why not?
We're trying to be good.
Yeah, I know. I'm raising my hand.
Okay.
Go, Jesse.
Oh, okay. Well, since again I get to go first, I'm going to steal the one that I like the most, which is I heard it from a wise person this year, but the biggest way to address uncertainty is through data and understanding. So it's really using that data to to dictate what my future actions might be, and we saw that a lot with historical data. If you think about inflation and things that we've seen in the past, that's great information to use moving forward. Maybe the one that didn't stick was the one that I just mentioned, which is, in theory, I love this idea of this Go team, and I know some people have used it. It may be organization specific, and it may be too hard to do. So, just the notion that you can have one dedicated team that can kind of dictate policy quickly, that I think maybe in theory looks like a really good way to move, but maybe it's not as easy to execute on.
Thank you, Jesse. Let's turn to Dave.
So I would say the one recommendation was not every indicator is a one size fits all to the client. A small credit union might look at the tariff impact differently than a larger credit union. Same thing in vertical. So I think it's really taking information, looking at how much it's going to impact you, and then how much are you actually willing to commit to address or take advantage of that issue. And it's not a one size fits all solution. The one that didn't necessarily resonate was talking to clients about looking at your customer holistically. I'm talking to the card issuer, and they want to know about, and they say, hey, we're talking anything about BNPL. And I said, have you talked to your deposit side? And they said, why? And I said, because every month the payment goes to a BNPL issuer, they would have that information there. Yeah, but we don't cross business lines.
Yeah.
So a lot of financial institutions don't talk across business lines to address an issue more holistically for their customers.
Tom,
Dave,
how about you?
Yeah, Dave, you had me really scared because I thought where you were going with that was the one that didn't resonate was exactly the one that I was going to say did resonate. So, but you went in a different direction. You were talking organizationally, holistically, as opposed to looking at the consumer holistically, which is where I was going to go. So I'm wiping the sweat from my brow from that. How am I going to pivot? Yeah, with my answer. But both of the resonate and the non-resonate for me get back to things that both Dave and Jesse were talking about. Dave was talking about sort of yeah, this notion of one size doesn't fit all, or one index, one measure doesn't fit all. Like different organizations in different circumstances will rely on different things that are of importance to them to make their decisions. Jesse went back to the theme of the greatest way to address uncertainty is with information, with data. And from my perspective, what I'll start off with the did not stick. We've been harping on, and not just us, many within our industry have gone on about the power of alternative data. We've been calling it, this differentiated data, this data that gives us views beyond the activity, to what consumers are doing and what situation they're in, beyond what traditional credit data provides. And I'm not changing my tune in terms of the relevance of that. It's, we've seen time and time again that does provide, richness. But what it does, it provides richness into a specific area of someone's financial life, the credit area specifically. And that's important. But what I think, is starting to become more and more obvious given the conditions that we've been in and given how different populations have been impacted by those conditions differently, is that it's even more relevant to take that holistic a view of the consumer. So not just, hey, what's his credit score? What's his payment history? But what are the other aspects of that household's financial standing? And how does that roll up to broader populations so that when we start to look at macroeconomic conditions and we start talking about things like the K-shaped economy and how different populations are thriving and some are struggling, we could actually understand that to a different degree. Why are some populations thriving? Why are some struggling? It's not necessarily because they have different credit scores or different income bands. It's all of these, things together. They're assets that they've built up over the years that they could fall back on. Are they homeowners or not? Do they have investments that they can use to weather economic storms? A lot of different things that I think we've talked about in general over the years, but it's becoming more obvious that that's of relevance.
Thank you, Tom. I asked for one. I should have also asked, and now I'm turning to for a timestamp on the response as well. Just if you could share the recommendation that has resonated and the one that has not, stuck to as planned.
So I think I'm going to go philosophical here. And I'll give you a one-liner on the philosophy of what I think has been occurring. Jesse really tapped into it, I think, specifically with respect to how preparation and opportunity seem like luck. But oftentimes it's the counterintuitive choice that transforms chance into change. And so when we think about how we're doing that, it's like where do you find that opportunity that might seem counterintuitive that really, propels forward, any form of change. And so I would say we're very opportunistic is the main point I would say, is what I'm seeing hold through.
Thank you. And maybe that's a wrap. I think I was going to add the more along the lines of what Dave shared on beyond us versus of us customer information and how to get that holistic perspective for these type of opportunistic situations, right? And when the growth mindset is set. Appreciate again sharing those recommendations. Thank you, Em. Thank you, Jesse, Tom, and Dave for joining me today. for sharing your insight and relevant themes. And this is from over 100 customers discussions across industries and verticals in the US, including how we connect these insights with actions. To our listeners, I hope you enjoyed today's topics. As a reminder, your feedback is important to us and critical to conversations like the one we had today. If you have questions or suggestions for future podcasts, please reach out to us at riskadvisors@equifax.com. We look forward to hearing from you.